Stocks are ownership shares of businesses that we value and try to buy at a discount. They are not pieces of paper that bounce around that we put Sharpe ratios and Sortinos on. Big difference. So it is possible that if we're good at doing valuations on businesses, the market will not reward us over the next couple of years, but that doesn't mean we're going to stop doing what we're doing. That's what stocks are, ownership shares of businesses. And so that is actually causation. We're like private equity investors when we think about stocks. We're buying the whole business, like most investors would. And so I don't know about value investing as defined by Morningstar or Russell may go in and out of favor or may stop working, I don't know. But valuation investing, that's what stocks are, ownership shares of businesses. So as Warren Buffett would say, value and growth are tied at the hip. Growth is a portion of how you value something. So I think that whole discussion, as bad as the statistics are, they're not very meaningful to me when I think about being a value investor. So let me turn this thing on. So let me talk about how we go about valuing businesses. And the analogy I usually use that works with most people is, let's say you're buying a house, and they're asking $1 million for the house, and your job is to figure out whether it's a good deal or not. Pretty straightforward. There are certain simple questions that you would ask to determine whether that's a good deal or not. One question you might ask is, if I rented out this house, net of my expenses, how much would I get for it? And if I could get $70,000 or $80,000, $90,000 a year net of my expenses for that $1 million house in a 3% interest rate environment, that 7 or 8 or 9% free cash flow yield on the house might indicate that it might be, priced well. What's another question I might ask if I were trying to figure out if that's a good deal or not? Pretty simple question. I pretty much know what you'd ask next. What are the other houses on the block going for? The block next door and the town next door. How relatively cheap is this relative to other similar houses? And that's what we do, by the way. We say, how cheap is this company relative to other similar companies, let's say in the same industry? How cheap is this company versus all my choices of company? How cheap is this being priced now on a cash flow basis relative to all my current choices? We also have another measure of relative value that we look at. And we go back in history and we see how the market has traditionally valued this business versus other businesses and how it's valuing it today. Just another measure of relative value. Simple way to think about that is if a company has traditionally been premium priced, and today it's available at an average price relative to the market, it's cheaper than it's traditionally been on this particular measure of relative value. We'd get a good grade. If a company has traditionally been bargain priced relative to the market, today it's available at an average price, more expensive than it's traditionally been on this particular measure of relative value, would get a bad grade from us. We would never use any measure of relative value all by itself, right? You can end up owning the cheapest internet stock at the top of a bubble. But we use our measures of absolutely cheap on a free cash flow basis. How much rent could I get for it? Relatively cheap to similar companies, relatively cheap to all companies, relatively cheap to history, as checks and balances against each other.